Thanks for joining this investment video. I'm Ross Bramble, a member of Hammacherberg's investment department. For investors, keeping their wealth and politics separate is not always an easy task. When emotions are involved, investors tend to let their political views dictate sometimes their investment decisions. To stay on track, we would encourage investors to vote through the ballot box and not necessarily through their portfolio. And in this short video, we'll discuss our perspective on election cycles and their historical impact on the markets. We should expect volatility leading up to an election, as a lot of promises are thrown around. But maybe we should view it as an opportunity rather than a risk. We should stick to our plan instead of trying to time the markets. We believe economic data and trends are ultimately more important than the election winner, and that corporate earnings in the economy will remain the market's most important drivers. Determining if there's a recession around the corner will likely be more important than projecting the next election's results. Markets have rewarded long-term investors under a variety of presidents and policies. Financial advisors often say don't rely on historical results. But history shows that election years, especially with an incumbent president running, typically lead to decent returns. Although we just had a switch in the Democratic nominee, I don't think that will change the dynamics too much at this point, since both were on the same ticket previously. There is some common sense to this, as sitting presidents tend to focus on popular, pro-growth policies to stimulate the economy, as we've seen in 2024. So history would say, stay invested this year and then wait to see what legislation can be passed in 2025 and beyond to determine any impact on earnings, consumers, and the economy. The first half of the year has been a positive surprise to most. At the beginning of the year, if you were to tell most analysts that the markets had to go from 6 expected rate cuts to just 1 or 2 rate cuts in 2024, all the while getting 3 hot inflation reports to begin the year, I think most analysts would easily have projected a very challenging backdrop for stocks, likely leading to negative returns given that elevated valuations we've had. But on the flip side, it is an election year, and history tells us, as shown in this chart, that markets have been positive every calendar year in which there's been an election including an incumbent president since 1940. Why is this? You can probably imagine. More government spending, which has led to above average GDP in election years, with more executive orders or other policy changes to help specific groups, all of which have led to stronger economies and positive market returns. Given the spending we're seeing this year, it's hard to argue this trend will not hold in 2024. Taking a step back to a bigger picture, it is unlikely that we would make a preemptive allocation change based on a projected election result. Lots of promises are made before people step into the ballot box. And although I've said this in prior elections, it's a good reminder that election outcomes themselves tend to only lead to short-term results. Some aspect of gridlock is likely to remain no matter what the results are. Majorities that can govern as a group are rarely found anymore in DC. We have seen that on both sides of the aisle during the last 3 presidencies. Small fractions have had tremendous success in holding up or even blowing up potential legislation. We believe the stock market follows corporate earnings over the medium and longer term. On this chart, you can see over time that the S&P 500 averages decent results, no matter who has been in the presidency, almost mid-teens returns for each. But often investors think that tactical moves are within sectors, and that is where presidential policy can really impact returns. The last 2 presidential terms would likely indicate otherwise. The consensus thought was that the pro-oil and pro-deregulation agenda under President Trump would benefit energy and financials. However, the result was the opposite, in fact, due to a variety of factors outside of DC's influence. Outside of technology, which has been a consistently good performer for each president, energy and financials have been the best 2 performing sectors under President Biden. There was a lot of hype for the Green New Deal and related stocks that would benefit, but it was undone pretty much by one independent senator who caucused with the Democrats. It is very tough to make projections based on campaign promises. Historically, we will wait until we get to the other side of the election, see who has and what amount of power, monitor the legislation that is being passed, and then evaluate the impact on corporate earnings, consumers, and the economy. Thanks again for watching this video. If you have any further questions, please reach out to a member of your client service team.